Hey everybody, Matt from 90th percentile.ca here. For access to more study notes, practice questions, mock exams, and end of chapter question videos, visit 90th percentile.ca and sign up for your free trial today. Link below in the description. Here we have a really, quick overview of equity securities. This module, once again, pretty qualitative. Nothing really to it. Just some definitions and key things we're talking about here are we're introduced to some different types of equities. So the most common, which we're all familiar with, would be common shares, and we're going to discuss the difference between common shares and preferred shares, and some of the main differences that the module talks about are the differences in voting rights, and then we'll also be talking about depository receipts, which are essentially non-domestic equity securities, which can give you ownership in a foreign company that's not traded on your domestic exchange. So we'll go over some of the key features of each of these through some questions. And then really quickly towards the end, we'll talk about the cost of equity and how the required rate of return on equity isn't as easily measurable as on some other types of instruments such as debt. So let's jump right into the questions. The type of equity voting rights that grants one vote for each share of equity owned is referred to as statutory voting. Difference between statutory and cumulative is that cumulative, you can delegate your vote to someone else, whereas here we have a 1-for-1 for each share. Next one, all of the following are characteristics of preference or preferred shares, except they are either callable or puttable. Yeah, this isn't true. They don't have to be callable or puttable. They don't have to have any options attached to it. They could just be normal preferred shares. But we can go down the list, and these are going to be true about preferred shares. So they generally do not have voting rights. This is true. And they do not share in the operating performance of the company. This is true as well. They're almost more similar. They're kind of a mix of an equity and a debt instrument. And then finally, participating preference or preferred shares entitle shareholders to participate in the decision-making process of the company. No, kind of goes back to this here. Convert the shares into a specified number of common shares. No, unless there's some conversion option attached to it. And C is the correct answer, which is receive an additional dividend if the profits exceed a predetermined level. When investing in unsponsored depository receipts, the voting rights to the shares in the trust belong to. So a depository receipt is basically a security that trades like an ordinary share on an exchange, but it represents an ownership in a foreign country that might not be listed on that exchange. So, a good example of this, I used to own shares of Alibaba, which doesn't technically trade on the New York Stock Exchange, but there's a depository receipt that essentially, owns these shares in the foreign country, so in China, and pools it such that these shares on the New York Stock Exchange essentially represent, or not, yeah, they do represent ownership in BABA, but there's some strings attached, which is related to the voting rights we're talking about. So if the depository receipt is unsponsored, meaning that the firm, such as Alibaba, wasn't involved in the issuance of these shares, then the party who created these shares, these depository receipts, such as a bank, is going to retain the voting rights. So that's exactly what it is right here. If it's a sponsored depository receipt, so BABA was involved in it, then the investors are gonna own it. But in this case, it's unsponsored, so the voting rights belong to the bank. Which of the following is incorrect about the risk of an equity security? The risk of an equity security is based on the uncertainty of its cash flows. This is true. Based on the uncertainty of its future price, this is true. These are the inherent risks. So like the future cash flows determine the price, and we don't know what the price is going to be. So that's the risk we take when we buy the equity security. So C is going to be our answer, and it says that measuring or risk is measured using the standard deviation of dividends, which is incorrect. It's measured using the standard deviation of the share price or share price returns. From an investor's point of view, which of the following equity securities is the least risky? Puttable preferred shares, callable preferred shares, or non-callable preferred shares. So when you have an option, such as a call or a put option attached on equity securities, the put option gives the investor the option to sell the shares back to the issuer. So in this case, and it's at a certain price, right? So let's say it's like sell at 40 bucks. So in this case, if the share price declines down to 30, then you know what, they can sell it back to the issuer at 40. So they make this little difference here. There's a little bit more to it in terms of the value of options, which we'll get into in the derivative section, but this is kind of an oversimplification just to prove or to show this point. So in this case, there's less risk inherent in the puttable preferred shares because they can sell it back to the company at a certain price. Whereas for a callable preferred share, it's the opposite, right? So the issuer gets the right to, let's do it this way, gets the right to essentially buy back the shares from the investor at a certain price. So from their perspective, they can buy it back at, let's say, 40, and the stock price goes up to 50. So the issuer will buy it back at 40 and then, you know, either hold on to it or sell it into the market at 50. So the call option benefits the issuer while the put option benefits the investor. Which of the following statements is most accurate in describing a company's book value? So book value of equity. Book value increases when a company retains its net income. Yeah, this is true. When you know your net income flows through from the income statement, then eventually it's going to go to the equity portion of the balance sheet, which includes retained earnings as well as, you know, the book value of common shares. So the price at which they initially issue their common shares, not the market value. So when you get net income, it's going to increase the equity value on your balance sheet. And just to clarify book value a little bit more, we have a question here where we're asked to calculate the book value of a company using the following info. So once again, we're worried about book value of equity. So very simple, you know, balance sheet equation, assets equals liabilities plus equity. So then our equity, by rearranging, is going to be equal to assets minus liabilities. So we can see total assets here, total liabilities right here. So 12 million minus a 7.5, and we get 4.5 million. They're throwing this number of shares and price per share out here to mess with you a little bit. And that's actually answer B right here, the 5.2 million. But if you multiply the number of shares outstanding by the share price, that's the market value, not the book value of equity. Holding all other factors constant, which of the following situations will most likely lead to an increase in a company's return on equity? A, the market price of the company's shares increases. No, ROE is based on book value of equity, not market value. And even if this was based on market value, this would increase your equity value, which would decrease your ROE, which is your net income over your equity, right? This increases, this whole thing would decrease. Moving on, net income increases at a slower rate than shareholders' equity. Well, no, because if your net income is 100 and your equity is 1,000 and your equity grows to 2,000, so it's doubling while your net income goes up to like 120, this is going to be a lower ROE than here. So this isn't right either. C is going to be our answer, and it is the company issues debt to repurchase outstanding shares of equity. So that's exactly it, right? So they're increasing their debt, which isn't, you know, really related to the ROE calculation. Like you do have to pay some interest, which is reflected in net income. But if you're increasing debt and using all of that to purchase back equity, you're going to write off or take off some equity from the book value of your equity because you're repurchasing shares in the market. Oh, it could be in the market, could be private equity as well, right? But regardless, you're decreasing your equity, which holding everything else constant will increase your return on equity. Which of the following measures is the most difficult to estimate? A, the cost of debt, B, the cost of equity, C, the investor's required rate of return on debt. Well, the debt measures are pretty easy, right? Because the cost of debt, we have like interest rates, we have yield to maturity, etc. So debt measures are pretty easy to estimate, whereas the cost of equity is a lot more subjective, and this is where you can see that we're using models such as like the capital asset pricing model, and which incorporates beta and some estimates for the equity risk premium, all of that. So we don't actually know for sure what the cost of equity is, and it's dependent on investors' expectations about the growth and profitability of the company. And then finally, a company's cost of equity is often used as a proxy for investors. It's always the minimum required rate of return. The maximum doesn't really make sense. It's always the minimum required rate of return.